About three things when we're trying to buy a company. So is there really clear shareholder value creation? And for shareholder value creation, we think about either growth, so rapid revenue and profit growth, return on capital, or a combination of revenue, of growth and return on capital, and then turnaround stocks, businesses that have got either very depressed asset backing value or depressed margins. So we're kind of thinking about a company life cycle. Businesses start off of growth businesses. They can generate high growth. As they mature, they tend to become more quality, so the higher return on capital, high and improving return on capital. And then you can pick up businesses after a decline phase where you are betting that the business can go back to the franchise it has been historically. And if you're right, you can kind of get that combination of cheap multiple on the way in and rapid margin improvement. We're trying to put capital into those three kind of categories. And we've got a bias to growth, understandably, given what part of the market we're investing in. So we're about 50% growth, and then the split of the balance is between the quality and recovery stocks. So we're looking for that clear shareholder value creation. And then we're looking for a mispricing. That's our valuation discipline. And then we're looking for momentum. So we're looking to kind of maximize our ownership of those businesses when they've got improving technical and earnings momentum. And I touched on that earlier in terms of running our winners and making sure we don't sell out too early if you've got businesses that are getting upgraded and have got buyers going after them. The business I mentioned earlier, the lawyer platform, is a fantastic example of something that kind of ticks two of those boxes because it's got growth. The business has delivered fantastic revenue growth, I think 25% organic revenue growth over the last 8 years per annum. It's delivered margin improvements. So the profit growth has actually been more like 33%, all organic over the last 8 years. That would put it, I don't know, top 10% of businesses in the UK in terms of the growth attributes of that business. But then if you look at the cash flow statement, they require very little capital. They had 50 grand of capex on 6.5 million of operating cash flow. They paid some tax. Everything else they've basically paid back to shareholders. The balance sheet has some goodwill on it, a little bit of working capital and some cash. So the incremental return on capital as they grow is extremely high. So that's a fantastic business in terms of high growth and high return on capital. The business trades on about 15 times. That might look quite punchy versus a market which trades on 9, but it generates a lot of cash. And actually, the shares are currently for £4.50, £5. A couple of years ago, those shares were trading at £9. And that's a massive derating, but it was trading on 45 times earnings at that stage. So the market got ahead of itself. We could see that at the time. We did take some capital out of the name. We added back to it recently below £4 because the market's just gone totally the wrong way. And that's the sentiment cycle that plays out, particularly in small caps. The business, remarkably, has basically just delivered to expectations or upgraded pretty much since IPO. So 2017 IPO, they downgraded numbers in 2020 for COVID. But actually COVID ended up being an enabler for the business because it showed people that working from home is actually quite liberating and quite enjoyable. And their model works on people working from home. So it ended up accelerating the growth of the business. But there was a short-term check in that. But if you go back and look at the shares, they've gone between 160 and £9 over the last 7 years. And so, as listed investors, we need to be active and we need to try and exploit that sentiment in the market as well.